Good morning, everybody. Happy Thursday. It's August 17th, 2023. Great to be with you today. My name is Bob Lang, and I run explosiveoptions.net. And wonderful, absolutely amazing chat room that you have a chance to join in right now for a pretty reasonable price. I'll talk with you about that in just a couple of minutes. But let's first talk about the markets and some stuff. We have a lot to cover today. I know we're getting started a little bit late, but let's see if we can squeeze a lot of this in over the next 15, 20 minutes here. So as you can see, S&P futures are up a little bit this morning, bouncing back from yesterday's shellacking. S&P 500 futures are up about 16 handles right now and getting a little bit better. We've improved our positioning here in the futures over the past 20 minutes or so. Dow futures up 50. Walmart reported earnings this morning. Cisco reported earnings last night. Those are two Dow components. And then later on today, we'll have Applied Materials, which is the Nasdaq name, and S&P 500 name. So Nasdaq also up about 66 points, which is about a little less than a third of a percent. Back over 15,000, as you can see on the Nasdaq 100. Certainly a bit of a bounce back here, but certainly pales in comparison to the pounding that the markets took yesterday and on Tuesday. So why did that happen? Let's take a look at the chart over here on the S&P 500. Well, first of all, what I want to show you is this: that why did the S&P futures starting to rally over here? Well, look down over here to the bottom right hand side. When we see volatility sellers are getting active here, they're selling the news, whatever news, the jobless claims or whatever, algos or whatever, whoever they are, selling volatility here. And it's a combination trade. When you sell volatility, you buy S&P futures off of that. Okay, so that's a combo trade here. And if we continue to get a slide in volatility, this is the volatility future for September. Okay, and you can see it's down 36 cents here. The VIX cash is down along with it. If we continue to see a slide today in here, we'll see the S&P futures start moving higher. We saw that evidence of that yesterday, of course, for a little while until after the meeting minutes came out. And you can see yesterday from the opening bell, we saw a volatility futures starting to decline. This is yesterday. And let's line that up with the futures from yesterday as well too. And you can see basically at that same moment, S&P futures were rising, and then all of a sudden we saw volatility sellers stop, and we saw volatility starting to rise, and the S&P 500 falling. And then of course later in the day we peaked up here, and the markets got pounded towards the end of the day as volatility sellers got busy again over here. Our volatility buyers got busy over here towards the end of the day. Let's line that up right over here. So you can see right here, we peaked right about here, and then volatility buyers started coming in at trying to buy some protection. So that's kind of the dynamic that happens during the trading day, and you try to pick and choose and find your spots. So we want to pay attention to what volatility is doing regularly during the day. Another chart I wanted to show you off of here is the daily. Here's the daily SPY chart, and you can see the SPY is corrected quite sharply from recent highs of about just under 460. Now we're just under 440. So we've corrected almost 4.5%, almost 5% off of the recent highs from early middle part of July, middle towards the end. But what I want to show you is down over here on the right hand side. And you can see here the New York Stock Exchange and the Nasdaq McClellan oscillators. Okay, McClellan oscillator is basically a breadth tool indicator that we look at to see whether markets are overbought or oversold, and we're severely oversold right now. Pretty good oversold condition here, due for a bounce. I'm not sure if today is that day of the bounce. But when we get to about a -100 on the NASDAQ or possibly 250 or more on the New York Stock Exchange, and again, we could go even lower than this today, even with the markets being up, it usually means there's going to be a whopper of a rally over the next 3 to 5 days. I don't know if it's tomorrow. I don't know if it's Monday, Tuesday, Wednesday next. I don't know. I don't know what day it is, but there's going to be a big, humongous rally. Usually these big, powerful rallies that occur come off of a deep oversold condition and even a a pasting towards the end of the day. Now, what happened yesterday? Let's take a look at the indicators, the internals from yesterday. Because this went Tuesday, miserable day on Tuesday, and also a miserable day on Wednesday. And if you can see with the VOLD, the volume accumulation distribution here finished at the lows of the day for the third straight day, actually, Monday too. The advanced decline also finished lower. We see a big shot up of the VIX, but take a look over here at the bottom right. This is something I've been talking about for the past week and a half. A rise in the put-call ratio, and we finished above 1, which is kind of an indicator that markets are pretty well oversold here. So am I surprised that we're seeing a bit of a bounce back today? No. Is it enough to convince the bulls to step in there and do some heavy buying, and is it going to scare the bears at this point in time? Probably not. So we certainly have some conditions there for a bit of a bounce, but I don't think it's going to be as much as people expect here. And I do think that the S&P 500 and the rest of the markets have put their tops in for the year of 2023. So that's probably as far as we're going to get here. That's just my guess. So we'll see how it goes into the rest of the year. I was talking about where I think that the S&P 500 could land at the end of 2023, and I think somewhere between 4,000 and 4,100. That would be about a 4 to 9% gain for the S&P 500 in 2023. Why so low? We're at 14, 15% right now. Why so low? It's because the interest rate environment is not very positive for equities. Even if the equity markets are strong, and even if the economy is fairly strong right now, the interest rate environment is not conducive for a market to be up 15, 16%. Now, I'm not telling the market what to do. I'm not telling what the economy what to do. I'm just giving you the facts as I see them and the probabilities as I see them, and certainly the markets could do something completely different than what I think is going to happen. Okay, so you have to have an idea, have to have a thesis going in order for you to have an analysis, interpret the data as you can, as best as you possibly can, come up with a thesis and work with that. So on the chart side, let's take a look at some charts here. First of all, let's take a look at the S&P 500 here. You guys can see this one here, and I've panned it out a little bit, and you can see that the market's been in the middle of a correction over here. We had this big, huge outside day when we hit the highs on the S&P 500 and closed lower. We had a couple of inside days following that, and then we fell hard at the beginning of August. We've been down 8 out of 11 sessions in August. 1, 2, 3, 4, 5, 6, 7, 8, and closed significantly below the 50-day moving average yesterday. So in order to recover that at 50-day moving average, we got to get back. S&P 500's got to get back above 44.50. And where are we at right now? We closed yesterday at 44.04. So we got to move up 1% just to get back to the 50-day moving average, right? And we move up 1%, and then you got to confirm it the next day or two to get it back above there. And look at this 20-day moving average. This is the tan dotted line over here. It's bending lower. And this is what I talked about on Monday. Remember the last couple of times we made a move below the 50-day moving average or towards that 50-day moving average. The 20-day moving average wasn't moving down. It was still moving sideways, or it was moving upwards. So we've moved down. So this is going to be strong resistance here. We've opened up below the Bollinger Bands as well too. We don't often spend time below or above the Bollinger Bands, but we are below it right now, and we could bounce back again to close within those Bollinger Bands today. The quality of the bounce back today is going to be important to see. So if we do start rising above, say 44.30, 44.40, and we make a run towards that 44.50 level, I'm more inclined to get a little bit more positive about things the next couple of days. But of course, we do have Friday coming up, trading tomorrow. It's a big expiration day. It's not as big as what we have coming up in September, but it's a big expiration day coming up tomorrow with a lot of equity options. It's a double, what they call it, a double witching tomorrow. Let's take a look at a couple of the charts over here. This is one that I've been talking about quite a bit. And look, this is one that should trouble the bulls right now. Okay, this is not the New York Stock Exchange. This is the Nasdaq new highs and lows list, right? And you can see that the new lows continue to expand versus the new highs, right? New lows are clustering over here to the right-hand side. And this is something that we saw back in 2018, back in September, October, early part of October, when the S&P 500 was making new highs. Of course, we're not making new highs right now. We're correcting right now. But still, we were making new highs, and this was starting to cluster here. So we had a major divergence there. And so when the breadth indicators are giving you a signal here, a red flag signal, you've got to listen. You got to pay attention here. It's been time since the start of August, okay? Even the first 4 or 5 days of August. It has been the time to step back, raise cash, put some protection on, step back, and let the market settle down. We don't have to trade every single day, right? But we do have to have our eyes open and pay attention to what's going on around us, right? We don't have to trade in NVIDIA every single day. We don't have to trade in Apple. Well, you can if you want to, but you're putting unnecessary risk out there on the table. And when you get a smackdown day, you're gonna have some heavy losses. Some of the names that I've really liked more recently, back in June and July, like an Uber and a Unity, Upstart being one of them, made some big money with Upstart. These things are broken now, right? I don't need to sit around there with calls and watch these things disappear and go to zero, right? And then all of a sudden I'm missing opportunity around me. When I have to cut bait on something, or when you have to cut bait on something, you let it go and you move on to the next opportunity. That opportunity comes in terms of time and rather than price. What does that mean? What does that mean? So in terms of time, maybe we're October 17th. Maybe that's the day you don't trade. Maybe the next day you're going to trade where the conditions are better is October 23rd. That'd be next Wednesday, right? So are you patient enough? Are you disciplined enough to step back and wait for the opportunity for you to trade when the conditions are much better, much more ideal? I talked about this in my blog this week. Take a look at it. It's on the website or on Twitter about being patient. All right. So that's the new highs, new lows. This should be something that should worry everybody, bullish or bearish, because this is indicating that there's going to be more downside ahead. All right. Let's take a look at bonds for a minute. Now, we don't really often take a look at bonds here. The 10-year yield closed at a high that it hasn't been at in 15 years. Now, it didn't quite hit that target back in October. Now, this is interesting. Back in October, we hit 4.3 something percent, about a week before the S&P 500 bottomed in October 21st, right? So we peaked here and we bottomed in October, but we're right back up here with the high yields, with still high inflation, with higher Fed funds rate today than we had back then. All right, and the stock market is up about 30% from back in October to where we are, 45% for the Nasdaq. So that's a pretty interesting dichotomy over here. We do have a nice bowl-shaped pattern over here. Look, if we pull back to say 4% from this level, I think we have some downside. I think people are going to start getting long bonds. But for right now, I mean, the trend is strong here. The dollar has been very, very strong. Bonds have been selling off, and issuance has been at record levels from the Treasury. So all the ingredients are there for continued interest rate rises. Now, there's another element here as well, too. The Atlanta Fed has something called a tool called the GDP now. Let's bring that up here. And they estimate what the GDP is going to look like in the previous quarter, the current quarter, right? So where are they at right now? They're at close to 5, almost 6% for this quarter. Current quarter we're in right now. We're about halfway through the third quarter right now. We have another 6 weeks to go before the end of the quarter. The end of the quarter, of course, comes in September 30th. So they're estimating that this quarter is coming in at 5.8. That's a hot number, right? Now, of course, We had good, strong productivity in the second quarter, lower unit labor costs. Wage growth is still starting to grow, but unit labor costs down. We have good growth in the jobs market. So there's some segments of the economy that are strong, but there's other areas of the economy that are not so strong, like manufacturing, not as good as you'd like it to be. Housing is starting to slow down a little bit as well. And financial stocks are faltering too. Loans are starting to, and then we do have people spending, but credit card debt is at record levels as well too. So I think the bond market is responding to what you see here on the screen. It's responding to a strong high growth scenario, right? Because when growth is strong, we often see investors saying, forget bonds. I don't need, I can get a great return in equities. And I'm shifting my allocation from fixed income and cash into stocks. And I think that's what's happened over the past few months. And if we continue onward, that means the the equity market is saying that, look, we continue to see strong growth in the economy into 2024. I think there's a bit of a tug of war going on here once again, because the Fed doesn't see it. First of all, I'm sure next month when they have their meeting in September, when the new projections come out, they're going to make some adjustments based on the strong growth in the economy in the first half of the year. Call it 2%, and perhaps the estimates coming out from Atlanta Fed for this one. But the Fed will continue to tighten if this condition persists and the tightness in the labor market continues to persist, which is still happening right now. We could see certainly above 6%, right? And a lot of people are talking about a soft landing or a no landing or whatever. This is really setting up for a hard landing, right? Especially if the Fed digs in their heels, right? And says, we're going to continue to see higher interest rates. Oh, and by the way, rate cuts, forget it. In 2024, there's actually only about a 70% probability of one rate cut coming in June of next year. Okay, would be probably the first rate cut coming in. That's only if the economy starts to slip a little bit. Don't forget something. Rate cuts only come under two scenarios. Inflation is coming down, which we know that the Fed is not happy about where inflation is right now, and if we need assistance to get growth growing because it's been sputtering. Okay, obviously we want to have that, and obviously the Fed is adamant about inflation coming down. Now, certainly it's down further than it was a year ago. It's a better situation today than it was in 2022. That's good. That's positive, but the Fed is not. If the Fed is not inclined to cut rates now, and they may even ratchet up rates even higher than many expect, 5.25 right now, up to 5.5, maybe 6%. That's going to have a negative effect on growth eventually. 2024, we could have that hard landing. We come down. If we print say 5% this quarter, and then we come down in fourth quarter. And then obviously in 2024, much lower numbers, it's going to feel like a recession. If you go from 5 to 2% growth, it's going to feel like a recession, but it's not going to actually be a recession. And believe me, the equity markets are going to tell you first, because they're going to respond to it much earlier. So this is something a new dynamic we all have to think about, because the strong growth really hadn't been there. Now it is there. And how is the dynamic between the Fed, the bond market, and the equity markets intertwined here right now? All right. Hopefully that makes some sense. So let's go back to the 10-year yield over here. We're moving higher again. Let's take a look at the 10-year yield here, and you can see here 4.258. We're almost to 4.6% right now. The 30-year. TYX 4.36. We're almost to we're actually ticking up to 4.4 right now. 4.4 in the 30-year. Okay. New highs we haven't seen since 2008, right? TNX now 4.292, 4.3 roughly. This is a new high on the 10-year yield. So when is it going to break? Right? Who knows? When's it going to break? I mean, is it going to have an effect on the growth stocks? It certainly has been recently, right? We've seen the Nasdaq falling a little bit more, the Russell 2000 falling even more than the other indices. So eventually, it's going to have an effect here, a negative effect on markets here, right? And people are going to say, look, I can grab that yield at 4.3%. At this point in time, I think people are saying, look, I can get a better return with equities right now than I can with bonds. But at some point in time, you're going to see that yield jumping up. You can get 5% for 6 months right now on treasuries. People are going to say that and say, look, you know what? I could probably do better buying treasuries that earn 5% or more than I can putting at risk at the stock market where the Nasdaq's already jumped up 36%. Is there any more upside left for Nasdaq? Anything other than Apple or Nvidia, right? So that's a good question to ask. So I think it's going to be it, everyone. Walmart again had good earnings this morning. They're pulling back a little bit here. It was up, it was down. Now it's back up again. Cisco actually with good earnings today as well too. Tonight we'll have Applied Materials, Farfetch, smaller name, Bill.com, Ross Stores, competitor of theirs, TJ Maxx came out yesterday with really strong earnings. So I'm sure Ross Stores is probably doing well. So some good news and some positive economic news. If we can get some of that, maybe we'll close out the week in a positive note. So the last thing I want to share with you, and again, we have this promo that started this week. It's called Deuce is Wild. Now, if you go to the website, you'll get a link here. Deuce is Wild. Now, if anybody is not in the chat room or they're not in the service, this is an excellent chance for you to sample it for a very minimal amount of money. This is normally $69 a month for all three services. You're going to get all three services: the chat room, amazing chat room, the EO service, which was up 22% in the month of July, and the spread trader, which is up 12%. Sam is doing an amazing job in 2023, all for $22 for 2 weeks. All right, Deuce is Wild, $22, 2 weeks. And if you can't make $22 or maybe even a few $100 trading, I don't know what to tell you. If you want to step back and just use $22, less than a quarter of a tank of gas, just if you're not driving an electric vehicle, just to watch and observe, that's fine too. Otherwise, this is a chance for you to try the service and make a little bit of money with us as well too. So that's going to be it, everyone. I'm going to wrap it up. Sorry, I'm running a little bit late today, but it was a good day to step back and talk with you guys. And I appreciate everybody listening today. Come on in the Deuce is Wild. It's only lasts to the end of the month. Go to explosiveoptions.net. You'll find it there. Thanks, everyone. Have a great weekend, and I'll see you guys all on Monday.